All right, what's up, guys? I hope you're doing well. Just going over the next post. This one is about the different monetary policy frameworks for the Federal Reserve. We'll go straight to the screen share and get going. So we got Chrome, of course. All right, so hopefully you can see this well. Everything looks good. Cool. So basically, just studying up on the different frameworks that the Federal Reserve can use. Because whenever you're doing policy or whatever, like political parties will have policy like platforms and stuff. Well, the Federal Reserve and central banks have different frameworks in which they use. And their different frameworks are defined by the amount of reserves in the banking system. And that's mostly because that defines the types of tools that they can use that are actually effective on short term interest rates. And so one of them, they're very, very creative in naming their frameworks. So one is with limited reserves, and the other one is with ample reserves. And there you go. So with the limited reserves, it's a lot from what I could tell, or at least what it seems like to me. It's very similar to how they are with their maximum employment goal. It's rather qualitative in nature. Like there's no defining line really, at least quantitatively, on the difference between the two frameworks. So when does the amount of reserves in the system become limited, and when does it become ample? There's not a number that they define. It's very it's kind of defined by the markets in a way. So like as the Fed defines it, a limited amount of reserves means there are just enough to satisfy banks' limited demand at the FOMC's target federal funds rate. Okay. And so basically, when there's a limited amount of reserves and they're just enough to satisfy their demand, they have to they affect or they influence the short-term interest rates by changing the amount of reserves in the system. So this is done by selling or buying securities from banks, right? Switching out treasuries or mortgage-backed securities for bank reserves, right? Quantitative easing is one way. And so, and as you can imagine, with a limited amount of reserves, any increment or decrement in that amount will change the lending capacity, in theory at least, if there's a reserve requirement. And so that means that the banks will change the amount of interest that they will charge, right? Because if they have more reserves, they'll probably be more likely to lend at lower interest rates, because if you default or whatever, then they have enough reserves, or they have more reserves to kind of counter that. If they have less reserves than usual, or they start taking reserves out of the system, that affects the amount of lending that the bank can do. If there's if there's a reserve requirement, and currently there is not. The reserve requirement is 0%. So, but we're also not in this regime at the moment. So more on that later. But what the Fed would do is they would do this trading of securities with banks, or depository institutions, I should say, on the open market on a daily basis. That's why the FOMC has a trading desk, or at least one reason why they could. And so, yeah, that's pretty much it for limited reserves. That's pretty much all there is to it, at least from what I've found so far. So with ample reserves, it's a little bit different. And so I kind of show this chart it's a Fred chart of the reserves of depository institutions, right, going back to 1960. So in 2008, or in January 2008, there were 44.9 billion bank reserves held by depository institutions. And we can see that by this little dot here, or this little end of the line. And then afterwards, it just kind of goes up, as you can see. And so I'd say that's a pretty big difference between limited, or a pretty obvious difference between limited reserves here and ample reserves up here on the right, where it just goes up. Okay, and so at the end of 2021, there was over 4 trillion reserves, our bank reserves held by depository institutions. And as you can see, that's way up here. And so I'd say that's ample. It's 100 times the amount of bank reserves, right? And so since there's no quantitative boundary between the two frameworks, the Fed just ensures there's enough reserves so that if they fluctuate widely, as you can see, it fluctuates obviously, um, then it won't affect short-term interest rates, right? So basically, a decent fluctuation in the amount of reserves um, won't affect the bank's lending capacity, right? At least that's the idea behind having an that's the idea behind operating a system with ample reserves. Okay, and so one of kind of a proposal in a way of something that I found and I think might have some merit in an argument on seeing where like that defining line is the repo spike or the reverse repo spike interest rates and overnight lending in September 2019, right? And so what I found was this is the SOFR rate, which is secured overnight financing rate from September 9th to the 19th of 2019, right? And so this is when you had that famous repo spike up to 10%, which isn't the SOFR rate. I could not find the reverse repo spike rate or the rate for some reason. And so this was a good proxy I found, at least I think. But anyways, the reason I bring this up, and another reason why I specifically use this rate, was that it was actually proposed by some Fed staff, and I linked the paper in here too, in which they actually wrote this proposal. It comes from the New York Fed too, but this essentially they said this was probably the reason that the reason had to do with the bank reserves was their argument. Right, and so essentially, when there's a spike in interest rates between lending between banks and stuff, right, secured overnight financing rate where the banks lend to each other overnight. So that spike in interest rates means that there's something wrong, right? And so something is causing the banks to not want to lend at the usual interest rate. They want more for whatever reason. So that's like an increase in risk. Right. And so their argument, from what I could tell, was that increase in risk that merits that increase in the interest rate was because there was not enough reserves in the system. And so they needed to provide more liquidity. Right. And at this time in September of 2019, there were about 1.5 trillion in bank reserves in the system. As you can see, in around 2015, there's almost 3 trillion, and then it kind of just tapers down a little bit, and then you get here to 2019 where the spike happens, and then all of a sudden we start printing or doing a lot more bank reserves. So that's something I've been thinking about, right? And also another thing that gives us merit, I think, is that the next month in October of 2019, the Fed came out and decided that they want to stay within this kind of framework with an ample amount of reserves in the system. Okay, and so another reason why are the tools that they can actually use, because since the amount of reserves in the system are changing the amount of reserves in the system won't affect short-term interest rates. That's kind of how they're defining a system with ample reserves, because if it fluctuates widely but doesn't change if the amount of bank reserves fluctuate widely to not influence short-term rates as defined by like the ample policy framework, because there's enough liquidity in the system anyway, then they have to find some other medium to affect short-term rates. And so they do this through administered rates, which is their interest on reserve balances or their overnight reverse repo offering rate. And these set a floor for Fed funds rate. Okay. For interest on reserve balances, it's kind of more self-explanatory, or it makes more sense if you just kind of think through it, at least to me. And so, like, so the Federal Reserve is like kind of like the perfect counterparty in a way. They can literally print the currency to, or that their debt is denominated in, so they can't default, right? At least not nominally. So if they basically, you will charge a bank or whatever will charge other institutions or other people more than they will the Federal Reserve, because other banks and institutions can't print the dollars that their debt is denominated in. And so obviously that'll be the lowest rate that they'll charge. For the overnight reverse repo, at first, it didn't really make too much sense to me at first. Mostly because I was like, okay, so the Federal Reserve is paying the interest for the interest on reserve balances. So that makes sense why it would be the bottom. But on the other way, if the Fed is getting a treasury, or I don't want to screw this up, because at first I was thinking that maybe it's the financial institutions that are, for reverse repos, it's the financial institutions that are paying the interest, right? That's what I thought at first. However, overnight reverse repo is more for financial institutions that aren't able or are ineligible to hold interest on reserves, right? Or they're ineligible to have bank reserves, right? And so basically, this was the Fed's way of providing kind of a bank reserve list and kind of a risk-free investment option for institutions that can't hold bank reserves. So that's why it's a floor, because it's supposed to be the risk-free version, which is why it's on the bottom, right? So it's the floor of interest rates because it's considered risk-free. If you add risk, that increases the interest rate, at least in my understanding. And also the ceiling for the Fed funds was supposed to be like the discount rate. And the website that really helped me kind of get this, I linked right here. I found it on the New York Fed's website. So kind of main takeaways. There's two different frameworks, one with limited and one with ample amounts of bank reserves. And not only is it the amount of bank reserves that define the framework, but it's the monetary policy tools that the Fed can use. Because there's not as much reserves in a limited reserves regime, changing the amount of reserves in and of itself will influence interest rates or short-term interest rates. However, in an ample reserve regime, by definition, there's so many reserves that changing the amount will not affect or should not affect short-term interest rates. Therefore, the Fed has to use alternative means, in this case, administered interest rates from them, as can be seen by the interest on reserve balances, and the overnight reverse repurchase agreement offering rate, right? And all of this is just to keep interest rates between the Fed funds target range. And again, this is a target range, so interest rates can fluctuate between there and everything else. This is not like, you can only pay 25 basis points. This is the target for the bottom of the range, right? And I want to make that up here too for SOFR, right? There's two different lines here. Again, this is secured overnight financing rate. So there's the median here, and then there's the 99th percentile. And you see there's a difference. It's because there's not everyone is just paying a single rate, right? It's especially with the 99th percentile, it's saying that 99% of the counterparties or whatever are paying at least below this rate. So like in September 2019, it was 9% around. It's still a market, and so on. kind of major sources or whatever that's really been helping me start kind of figure this stuff out or try to figure this stuff out is Eurodollar University with Jeff Snyder and Emil Kalinowski. And then also, and I am so sorry for mispronouncing your name. If I'm not entirely, I can't pull the name up in my head, like how it's spelled to like say it, because I haven't read him a lot, but I know him from his newsletter, The Macro Compass. It's like Alfonso something. Sorry if I mispronounced your name. He also did an interview with Emil and Jeff. So this stuff is, I think it's interesting, but there's that. So hopefully this was helpful. I'm kind of a little bit excited because it's starting to make more sense to me. I can stop the share now because we're done with that. But it's starting to make a lot more sense to me. And so hopefully it helps giving you guys more value as well as I try to figure it out. And I'll try to get a more sturdy desk because I didn't realize how much it shakes. So I hope it's not too bad. But yeah, that's all I got for this one. So I hope you guys have a good night, and